The U.S. economy faces challenges, nearing recession due to rising inflation, higher interest rates, and low savings rates, marking the end of prosperity. But what about your personal growth? How can you still invest and make money without panicking? While most of us have never personally experienced a major recession in our lifetimes, there is one man who has weathered many such storms, Charlie Munger, the vice chairman of Berkshire Hathaway. Having lived through the COVID panic, the 2008 financial crisis, the dot-com bubble, the oil crises of the 70s and early 80s, as well as the 4 recessions during the 50s and 60s, and even witnessing the Great Depression as a child, Munger possesses a wealth of experience when it comes to investing during economic downturns. In this video, we will delve into Munger's recent insights shared during the Daily Journal shareholders meeting. We will also explore a few valuable pieces of investment advice that we, as value investors, can embrace during these challenging times. According to Munger, it is undeniable that the increase in interest rates adversely affects stock prices. While it is natural for rates to rise, maintaining them at zero indefinitely would not have been feasible. Such circumstances serve as yet another aspect to adapt to in our investment journey. Munger acknowledges the existence of both headwinds and tailwinds, with inflation being one of the headwinds. In his view, given the nature of politics in a democracy, it is inevitable that we will witness more inflation over the next century. Consequently, the Daily Journal prefers to invest in common stocks rather than government bonds. This perspective from Charlie Munger is quite characteristic of him. If you look back at his interviews throughout the years, you'll notice that whenever the conversation turns to macroeconomics, such as interest rates, inflation, or currency, his response is always centered around adapting and navigating through the circumstances. He never holds strong opinions on what will happen next or what actions the Federal Reserve should take. The reason behind this approach is that predicting the course of inflation and the subsequent actions of the Federal Reserve is inherently unpredictable. Consider this. Even the Federal Reserve, the institution with direct control over interest rates, struggles to forecast where inflation and interest rates will stand 3 or 6 months from now. Their attempts at prediction are consistently flawed. Let's not forget that not long ago, Jerome Powell himself held off on interest rate hikes, believing that inflation was merely transitory. Therefore, instead of attempting short-term predictions and making investment decisions based on such hypotheses, Munger prefers to stay the course and treat macroeconomics as a tide that can either be in your favor or against you. Munger readily admits that he has no clue about short-term outcomes. However, he excels at anticipating long-term expectations. His investment strategy is firmly grounded in focusing on what is likely to happen over the span of 10 or 20 years, rather than fixating on the next year. This approach forms a fundamental pillar of his success, as he has generated wealth not by engaging in short-term bets, but by holding on to high-quality businesses like Berkshire Hathaway or Costco for extended periods. In fact, Munger recalls a valuable lesson he learned early on involving an experiment with children and 2 marshmallows. As a child, he demonstrated the ability to delay gratification by resisting the temptation of an immediate marshmallow, the ones who went on to achieve success in life. This principle stands as one of the most beneficial hacks that consistently propels value investors forward, and it holds great significance for investment success. During recessions, it is crucial to postpone instant gratification and extend your investment time horizon. Undoubtedly, recessions are challenging times for stocks, as Munger noted that rising interest rates pose a threat to stock prices. Therefore, it is imperative to shift our mindset from seeking immediate profits to making investments that will yield returns in the long run, perhaps over a span of 10 years. While it would be ideal to reliably and immediately make money, unfortunately, the stock market, particularly during recessions, does not operate in such a manner. However, let's now explore another crucial philosophy for successful investing during such times. And before that, it'd be nice if you show your support for our work by subscribing to the channel and turning on the notification bell. That will also help you stay up to date with our informative and useful uploads. According to Charlie Munger, rationality is the key to achieving success in life. By avoiding irrational behavior, you gain a significant advantage over 95% of people who succumb to various irrational tendencies. Consistently maintaining rationality provides a substantial edge in life. Moreover, the virtues of patience and deferred gratification are practically essential. Therefore, the secret to investing lies in combining patience with rationality. With this approach, investing becomes almost effortless. Many fail to comprehend the psychological aspect of successful investing, which we believe is roughly 10% intellect and 90% temperament. The ability to think independently and make decisions based on objective evidence, rather than succumbing to media influence, is a tremendous advantage, especially during recessions when the media tends to be biased towards fear and uncertainty. Munger is absolutely right. Delayed gratification combined with rational thinking is the winning formula. However, as he states, it is always challenging. Yet, with practice starting from a young age and continuous improvement, it becomes easier to master. While we acknowledge that rationality and long-term thinking are the keys to attaining stock market riches, in practice, it is exceedingly difficult to remain rational at all times. This challenge is especially pronounced when witnessing others around us taking significant risks on short-term gambles, which annoyingly pay off. However, Charlie's insightful advice proves invaluable. You'd climb as hard as you can by just advancing 1 inch at a time. That's the secret of life. And now, there's always somebody who's a little nuts and who succeeds. But for every guy who succeeds, there are 1,000 failures. Rather than being one of the gamblers, it is better to adhere to the tried-and-true method of long-term value investing. These were Charlie's thoughts on investing philosophy during recessions. Moreover, he emphasizes essential lessons about the value investing strategy itself. According to Munger, one of the most surprising aspects is how the business world resembles the physical world, where animals die in the process of improving species and adapting to niches. Similarly, in capitalism, businesses face the same fate. For instance, the downfall of Kodak, a once dominant force in the world with unparalleled knowledge in film chemistry, and the decline of Xerox, which was once remarkable. Ultimately, everything comes to an end, and no eminence lasts forever. This underscores the significance of having a durable economic advantage. It is the most crucial characteristic for ensuring a company's survival, particularly during a recession. Businesses with strong moats, like Coca-Cola, which have been able to raise prices and increase profits despite consumer hardship, are highly attractive during economic downturns. However, it is important to remember that nothing lasts forever. Even companies with substantial moats will eventually perish. Apple, Google, and Tesla all will meet their end one day. As Munger suggests, the cases of Kodak and Xerox remind us of this unpredictable reality. Therefore, it is crucial to scrutinize and assess the companies we invest in. How have they fared over the past year? If their revenues and profits have remained consistent or even risen, it is a positive sign that they possess some form of advantage. On the other hand, a significant decline in operating income indicates that they may lack a strong enough moat to withstand the forces of capitalism. Prioritizing businesses that can thrive in challenging economic conditions is of utmost importance because holding great businesses should always be the primary focus. When evaluating a company for potential investment, Charlie Munger places great emphasis on both the business itself and the management team. While he shares this perspective with Warren Buffett, their journey to this viewpoint was not straightforward. Occasionally, a remarkable business may be led by an underwhelming manager. Take the example of Coca-Cola, where a man with a significant mental disorder ran the company for years. Astonishingly, the board assumed he was intoxicated and allowed him to continue in his role without intervention. Nonetheless, Munger firmly believes that the most crucial factor is ensuring that the investment is fundamentally based on a strong business foundation. This entails examining key aspects such as excellent economics, a solid moat, robust cash generation, manageable debt levels, and self-sufficiency without a constant need for capital infusion. By possessing these characteristics, a business becomes resilient, capable of weathering a recession or even mismanagement and unexpected setbacks like a factory explosion. Such businesses are the ones Munger encourages investors to seek, especially during uncertain times like the present. Moreover, it is essential to maintain honesty throughout the investing process. If, for instance, you have a speculative Web3 company in your portfolio that is hemorrhaging cash, it is crucial not to deceive yourself into believing that everything is fine. It is vital to resist falling into the psychological trap of persisting with investments that should be abandoned. Instead, develop an investing checklist, review it regularly for each investment, and pay attention to any yellow or red flags that arise. In summary, the key takeaways from Charlie Munger's investing lessons are, firstly, it's crucial to remain rational even during tumultuous times when it may seem like the sky is falling. Secondly, focusing on a long-term perspective simplifies decision-making and leads to better outcomes. Thirdly, successful stock market investing is a gradual process that involves taking small steps, one after another, until significant progress is achieved. Fourthly, in challenging times, it is essential to identify companies with strong moats, those with sustainable competitive advantages. Fifthly, it's important to stay updated with the performance of companies in your portfolio, and be willing to let go of underperforming investments if necessary. Finally, avoiding denial and remaining objective is crucial to making sound investment decisions. And now we'd love to hear from you. What strategies do you plan to implement during this recession? Are there any particular sectors or investment vehicles you're considering? Share your thoughts in the comments below. And don't forget to subscribe to our channel and hit the bell icon for more valuable insights on investing and navigating challenging economic times.